It's wonderful when you follow a presenter that you agree with, and I agree with everything that Nick has said. I'd firstly like to apologise for the shower that is behind me. It turns out you can live in quite cheap places if you're willing to put up with a shower in the middle of your study. So yeah, it's difficult to be a value manager and not to live a value life. So it does look odd, but apologies for that. Now, if we could just go to the next slide, please. I manage the Schroder Global Recovery Fund that takes a very similar approach to the approach Nick's been describing, but on a global basis around the world. This short set of slides will just cover three things. So the first one is value over the long term. Nick has shown you some charts on that, and I'll show you some slightly different ones, albeit supportive. I'll then talk about stock picking within value. How do we try and pick the best shares within this part of the market? And then thirdly, give you some examples of opportunities, none of which Nick has showed you, but some different kinds of opportunities to highlight how we find cheap stocks and why we think shares are cheap. So if we take value over the long term, if we could go to the next slide, please. Let's imagine we've all got very, very lucky great-grandparents. And let's imagine the great-grandparents won the lottery in 1926. What this chart shows you here, and it seems to have come through pretty badly, I apologise in terms of the scales, is 10,000 in 1926 invested in a value strategy would be worth over £1 billion today. That is an extraordinary return if your grandparents chose to invest it in a value strategy. If, however, they chose to invest it in a growth strategy, it would today be worth less than 100 million. And what's striking about this is you've got 10 times the return in value, despite going through a period of some of the most profound changes in humankind. Many people say you have to invest in growth shares because the world is changing. Because the world is changing so fast and so significantly, you need to invest in the shares that are changing the world. But if we look through this period, investing in value shares has delivered you 10 times what growth shares have done. And through this period, we've had a doubling of global life expectancy. Through this period, if you wanted to get from London to Norwich, where I grew up, any quicker, you needed a faster horse in 1926. And now you can travel any which number of ways. Through this period, we've had the Second World War, the Cold War, the rise of Japan, the rise of China. We've had dramatic changes, the introduction of domestic electricity, a calculator, a computer, and the internet. Despite all these changes, and all the occasions you might have thought of to invest in the new world, the changes that were going on in the world, value has absolutely smashed growth and delivered a phenomenal return. So, like Nick, we are very, very confident that over the long term, value delivers. But the challenge many people say to us is, well, that's all very well, Simon, but actually I haven't got a 100-year investment horizon. And we understand that. But what we hope is that most people might have a 5-year investment horizon. If you're invested in the stock market, our belief is that you should have at least a 5-year investment horizon. So then we said, well, what happens if you invest in value on a 5-year view over and over again through the decades? So you start in 1926 and you invest in value and you hold it for 5 years until 1931. Then you do it 1927 to 1932, and you do that every single month. So January 26 to January 31, February 26 to February 31, every single month up until the present day. How many times would value have beaten the stock market? And if we go to the next slide, please, we will show you that on a scatter chart. And I think the results here are extraordinary. In 84% of occasions, value beat the market. 84% of 5-year periods since 1926, value outperformed the market. And if you take the bottom left corner, in only 4% of occasions did value underperform and lose you money. So 84% of the time, value beat the market, and in 92% of the time, value made you a positive return. That is an extraordinary record. And when you combine that record with the incredible long-term return, the 10,000 into over $1 billion, we think value has extremely attractive credentials to form a part of the portfolio, a part of clients' portfolios, a part of your portfolio. So value has worked over the long term but actually, on average, it has also worked over 5-year holding periods. So we are value because the evidence says it's value. We're also value because we think it makes sense. If you go to a shop and the jumper you want to buy is 20 quid, but the next time you go it's 30 quid, most of us would be less inclined to buy it. But yet the stock market loves shares that have gone up. Meanwhile, if you go into the shop the next week and that 20 quid jumper is on sale for a tenner, we're more inclined to buy it because that makes intuitive sense. And it is the same with the stock market. There is empirical evidence for value, but it also makes intuitive sense. Buy shares when people hate them and sell them when they love them. So that is why we're value and why we believe many people should have a significant exposure to value. If we go on to the next slide, the challenge is, though, picking the right shares within value. So this slide here shows a summary of the way in which we try and pick shares. And our basic view is that value delivers over the long term. But if we can do a better job than average and we can pick the best shares within value, we believe we can then deliver an even better return for our clients. So this summary of our process starts in the top left where it's information. So the first part of our process is where do we get our ideas from? And we get our ideas from valuation screens. Valuation screens that keep us broadly in the cheapest 20% of the market. Now that means that we can be confident we're investing in the shares that we believe have the greatest chance of outperformance over time. But it also means our clients can be confident that if they're buying us to be a value fund, they will get value. We will deliver value because it's the only place we're looking for ideas from. However, that takes very little of our time. It takes virtually no time at all to run a screen. Where we spend a lot of our time is in our second edge, which is our analytical edge. And this is where we do the hard work, the deep, rigorous work that Dan talked about, paying someone else a small amount of money to do the hard work, the expertise for you. And what I'd say here is the first thing we do is we go and build a 10-year model, a 10-year version of the company. But that is not a 10-year model of the future. The investment industry calls that forecasting. But I believe you will all know a much better name for that, which is guessing. We don't spend our time guessing the future. We spend our time going through 10 years of historic profits, profit and loss account, the cash flow account, the balance sheet account, and the notes to the accounts, all of the information you can find in an annual report on a company. Now, for me, that comes very naturally. As an 8-year-old, I was given my birthday present. It looked like a book. I thought, terrific, history of Norwich City or something exciting like that. But I opened up this present, and it was actually an accounts book. My parents, my dad was a forensic accountant, had given me an accounts book as an 8-year-old. And from then on, I had to keep my own accounts, the income, which was picking up litter on our road, and the cost, which was 1 penny sweets and football stickers, basically. But I had to keep my own account. So I grew up having to do accounting. The rest of the team I work on, 8 other investors, had a much more exciting and enjoyable upbringing and have had to learn forensic accounting later on. But the point is, having that detailed, rigorous, forensic approach to understanding what goes on in the accounts helps us make less mistakes, helps us pick the best shares within value. Because we use that to answer what we call our 7 red questions. And these are the 7 reasons why we believe a share can look cheap, but not recover. So things like some of the areas Nick talked about. What is the structural change in this business? We're happy to buy companies undergoing structural change, but we want to make sure we understand that structural change. Is the balance sheet good enough? Our average holding period is 5 years. Is the company going to get through that period, or does it have too much debt? Do the profits turn into cash? A number of accounting questions. ESG, what's the stakeholder relationships? Are they sustainable? We answer these 7 questions every single time in the form of a checklist. And we do that because we've all read a book called The Checklist Manifesto by Adler. He is a phenomenal doctor in the US, and he went around the world and he said, how do we make less mistakes? How do we get better results from surgery? So he looked at the building trade, the airplane trade, pilots, and they had all introduced a checklist. Because it turns out as humans, we're not very good at remembering all the things we need to look at, or we don't want to remember all the things we need to look at. There's a reason We have a shopping list. There's a reason my wife gives me a shopping list, because if I haven't got it written down, I go to Tesco's trying to buy 5 things and come back with 4. So we introduced the checklist to say, let's go through every single reason we believe a share can look cheap but not recover. But the problem with that is you end up biased. You love the fact that you found some hidden valuation somewhere that no one else has understood, but you hate the fact that the board of directors is extremely undiverse, entrenched, and we think full of people that aren't that good. So the behavioural edge, which is the third one here, is where we distill all of that work into risk and reward. We say, what's the risk of permanently losing your money? And what is the upside? What's the percentage upside in the share? So if we find a company with upside of 80, 90%, but a risk score of 10 out of 10, maximum risk, would we buy that? No, we don't think that trade-off's attractive enough. But if the next share we look at has upside of 80 or 90% and a risk score of 1 out of 10, would we buy that? Absolutely. Those are the asymmetric trade-offs we're looking for, much more reward than risk. And over time, we probably say no to over 90% of the companies we look at for one reason or another, because it is not asymmetric in our clients' favor. So that's the behavioral edge. The final edge I'm going to talk about is the organizational edge. Every single stock we've looked at since 2014, we've saved into that slightly weird looking fridge type thing, which we call our value archive. So we have the 10-year model, the 7 red questions, the risk and reward, whether it's a buy or a sell. And that's now got in the region of 3,000 entries in it. And that is an incredible resource for us to make sure the companies we own have still got lots of upside to fair value, to make sure any companies we've previously said no to, but we said we'd buy them at a certain price, to make sure we know when it's reached that price. But it also allows us to get better and learn over time. So each year we pull out the drawer from 5 years before, and we say, what do we get right and what do we get wrong? Are we good at sales forecasts or margins? Are we good at making these judgments or those judgments in this sector or that region or this individual or that individual? And we can use that to get better and better over time. Our objective is to be the best value investors we can possibly be. And to do that, we need to get better over time on the basis of data and evidence rather than our memory, because sadly, human memories of the decisions they made 5 years before are very, very flattering to us. We basically all think we made good decisions 5 years ago, but this is written in black and white, and we can see clearly where we've got advantages and disadvantages. So that's a process, very, very quick, very simple. Start with the screen to make sure we're only looking at the cheapest companies, do a truckload of rigorous, disciplined forensic analysis, distill it into risk and reward and only buy the really attractive ones, and save it all to later. But let's see what kind of stocks come out of that process. If we could go to the next slide, please, I'll highlight a few opportunities in value today. So here are some companies in Japan, most of which no one will ever have heard of. But Japan's a really interesting country. So in the 80s, it had one of the biggest booms any country has ever seen, and the stock market went through the roof. And it's had a very, very long and very disappointing for many Japanese watchers and people living in Japan, kind of degradation since then. The stock market's gone down and down and down. Interest rates have been very, very low. And it's been a very difficult place for investors to make attractive returns for clients. But we think there are some things that are changing in Japan. Firstly, anyone that was running a business in 1980 is unlikely to be alive today. Anyone that was starting a business as a grad in 1980s is likely to be about to retire today. And so as a result, we have a generational change in Japan in terms of the people running businesses. We've got a government that is desperate to see better returns. And the problem we've had in Japan is companies have been hoarding cash, refusing to return capital to shareholders, desperate to have fortress balance sheets. Now, we respect companies that want fortress balance sheets, but you've got to measure it. You've got to make sure it's not ridiculous. And you've got enough of a comfort zone to make sure you can weather a storm, but not so much that you can weather a storm lasting 200 years. And if you look at some of the companies we own in Japan, there's some amazing opportunities here. The likes of a DNA or a Tokai Rika or a Nippon TV. They more or less have more cash and investments than their market caps. Now, a simple analogy to that is, let's say you go and look around a house that's for sale for 200 grand. You look around the house, you think it looks all right. It's nothing special, but it's a nice house and it would do you. And it looks fine. You've had a survey. Survey said there's no great problem with that house. You then go back and look one more time and decide to look under the carpet because you're worried that they might be hiding something bad under the carpet. You pull back under the carpet and you find 200,000 in cash. So you can then buy the house for nothing. You buy it for 200,000 and you get 200,000 and you've got the house for free. Well, that's today what you get with DNA, Tokai Rika, Nippon TV. There are other companies here that are dramatically changing the way they behave. Nikon, you'll think of Nikon cameras. We all know there's going to be less cameras sold in 5 years' time than there were 5 years ago because we all take good photos with our phones now. Well, we have the ability to take good photos. Mine certainly are not good, but we have the ability to. Well, Nikon is actually mostly an advanced lithography business. Intel can't build a new fab. Intel, one of the most important and significant companies in the world, cannot really operate without Nikon. Meanwhile, their camera business, they've moved all of the costs of their camera business to Thailand. A dramatic change for a Japanese business, and one that now means the camera business, which has been losing money for years, is profitable. So we think Nikon's a really interesting business. KDDI returns all of its capital, all of its free cash flow to shareholders, basically each year. Dentsu has just sold its head office for about a third of its market cap. So an amazing array of businesses that are attractive, that are cheap, that have great balance sheets, and where managements are behaving in a more shareholder-friendly way. But what's unbelievably interesting, I think, about these is whether these shares do well or badly is nothing to do with interest rates. It's nothing to do with inflation. It's really nothing to do with whether the war in Ukraine lasts another month or another 10 years. It's nothing to do with any of the macroeconomic factors that people can so easily spend their time thinking about. It's an array of businesses exposed to different markets that are super cheap with great balance sheets and on the whole management teams that are behaving in a more shareholder-friendly way. So if we just go to the next slide, I'll just summarize what I've been talking about. The first one is that we believe value delivers over the long term. It delivers that 10 grand into over $1 billion. On average, over 5-year holding periods, it outperforms the market most of the time, 84% of the time. That is a phenomenal track record for an investment style. Secondly, a thorough process can help you get the best from it, can help you find the most attractive shares within value, and can help you deliver even more attractive returns for clients. And finally, as a simple example of the kind of shares we're able to find, there are businesses in Japan that you're paying nothing for the business. They've got cold, hard cash and investments that are worth the market cap, and where you get the companies for free. And our portfolios are full of a range of businesses around the world exposed to different things that we believe are cheap, and we believe on a 5-year average holding period can deliver great returns for clients. And I'll stop there and we'll have some questions, I hope.